Hey, how's it going, guys? In this video, I will show you guys 3 of the most powerful indicators that you must have to help you navigate or even profit from any bear markets. All these 3 indicators are completely free to use on TradingView. I will show you guys exactly how these 3 indicators work, how to use them to find the best trade setups, and most importantly, at the end of the video, I will show you guys how to find them on TradingView for free and also the important settings for these indicators. Alright, let's get started. The first indicator is called volume profile. No matter if you're a short-term trader or a long-term investor, in a bear market, tracking the volume action is way more important than tracking the price action. So what exactly is this volume profile indicator and why it is a much better choice than our traditional volume indicator? The traditional volume indicator that we usually use at the bottom of the chart can only show us the trading volume for each trading session based on the time frame we choose. But with the volume profile indicator, we can track the amount of volume traded at any certain price levels that we're interested in. This is extremely powerful and also very useful, and let me show you why. For example, this is the weekly chart of S&P 500 ETF from June 2020 to June 2022, exactly 2 years. With the traditional volume indicator, we wouldn't get much valuable information except the trading volume went up during the bear market sell-off. It is definitely not enough to help us make any trade decisions. However, if we add a volume profile indicator, we can see a whole new different story. Alright, this is how the volume profile indicator works. Basically, it tells us 3 pieces of super valuable information. First, the length of each bar tells us how much volume has been traded at that particular price level within the time period of your chart. The longer the bar is, that indicates the higher volume was traded around that price. For example, we can clearly see that from June 2020 to June 2022, we had 3 volume peaks at $440, $415, and $390, the 3 different price levels. That tells us there were a lot of buying and selling activities going on around those price levels. If we draw a line at each of those price levels, we can see that these are exactly where the key market structures are located for S&P 500. Those key market structures, or oftentimes we call them the support and the resistance, are exactly places where a lot of trades were made between buyers and sellers, and those are the key levels we should be paying the most attention to. With the volume profile indicator, we can sort of do the reverse engineering. We can start from where the highest volume levels are and find those key price levels where the most trades happened with the highest volume. Speaking about the highest volume, the second piece of extremely important information we can get from this indicator is this red line called the point of control line, or the POC line. This POC line can show us exactly at what price level where the highest volume was traded during this time period. In our case, the highest traded volume from June 2020 to June 2022 was around $430 to $440 level. And right now, SPY is trading at $380, which is about 15% lower than the peak volume level. That tells us there's a high probability that the majority of the investors over the past 2 years are currently in loss, which indicates the selling pressure will be higher than the buying pressure in such a market environment. This is a very important piece of information, especially when it comes to looking for any trade setups, which I will explain in the later part of the video. Alright, the third information this volume profile indicator can give us is that it can tell us at exactly what price range where the 80% of the total volume during this time period has been traded. When we look at these volume bars, we can see that the 2 bars on the top and some bars at the bottom are more transparent than the rest of the bars. The bars in the middle that have the full opacity are the bars that represents the 80% of the total volume that has been traded during this time period. In our case, is 2 years, which means over the past 2 years, from June 2020 to June 2022, 80% of the trades were actually made between $360 and $470 this range. If we draw this range on the chart, we can see that that is exactly where the market top is and our current bear market low is. We can also draw a fixed range volume profile indicator that connects the all-time high and our current bear market low. So from the market hitting the all-time high back in January this year until today, at around a period of 6 months, 80% of the trading volume during these 6 months were actually traded at the price range between 410 and 460. The highest traded volume over the past 6 months happened at this red POC line, which is around $448. Remember, just now we mentioned that over the past 2 years, the highest traded volume happened at around $440. So what does it tell us? It tells us that although we're currently in a short-term rally from the bear market low, most of the investors are still in loss. the selling pressure is still higher than the buying pressure, and we should expect there's going to be a large amount of selling orders that are to be placed at this range and form a strong resistance between these two POC lines, which is between $440 to $448. So one of the high-quality trade ideas that we can immediately come up with by just using this volume profile indicator is that if SPY rallies back to $440 to $448 range, we can short this ETF. Stop loss can be placed at a 475, which is slightly above the upper volume range and close to the all-time high. Profit target can be set at a 360 when the market breaks down and makes a new low. The risk to reward ratio is about 1 to 3, which means we will be risking $1 to make $3. Of course, there are a lot more things, trade ideas, and strategies that we can talk about when it comes down to this powerful volume profile indicator. I want to keep this video short and leave some time for other two indicators, but do let me know in the comment section below if you want to learn more about this volume profile indicator. I can make a separate video deep dive into this one single indicator in the near future. The second indicator that you must have during the bear market is the volume-weighted moving average. As we mentioned earlier, when the market enters a bearish environment, volume and the volatility will go up significantly, and that is exactly the perfect market condition for volume-weighted moving average to shine. So what is the difference between the volume-weighted moving average and the simple moving average? Simply put, both of these two moving averages are designed to calculate the historical average price at a certain time period. But a volume-weighted moving average will put more weight to those price actions with a higher volume. In other words, when volumes are low, these two moving averages will behave in a very similar way. But when the volume suddenly increase, for example, when a big breakout or a market crash happens, which happen quite often in the bear market, the volume-weighted moving average will move faster and then move away from the simple moving average. This is huge because it can give us some extremely important early signals and help us get in or get out of some certain trades much earlier. Everything moves fast with high volatility in a bearish environment. If you can get in and get out of a trade earlier than the crowds, it can make a huge difference on your total return. But my favorite way to use volume-weighted moving average and take advantages of the increasing volumes is to combine it with a simple moving average and generate some high-quality swing trading signals. For example, this is the daily chart of Tesla from 2021 to 2022, exactly 1 year. This blue line is the 50-day volume-weighted moving average, and this orange line is the 50-day simple moving average. The strategy is pretty simple. When the blue line crosses below the orange line, that means the market enters a potential short-term bearish momentum. So we enter a short position. We close our position when these two moving averages start moving together. So in our case, according to the signals, we short Tesla on January 25th at a closing price of $880, and then we cover our short position on May 18th at $578. That is a nice 34% return in just 4 months. When these two moving averages move together, like what we're seeing right here, that means the volume during this period is relatively low, and we should stay out of this stock during this time. And when the volume within the moving average moves above the simple moving average, that indicates the stock is entering a potential short-term bullish momentum. Then we should enter a long position. So in our case, we can long Tesla on October 22nd at the price of $895 when the blue line crosses above the orange line, and close our trade on January 6th at $1,077 when these two moving averages start moving back together again. That will be a 20.3% return in just 2 months. This is just one of the many examples to show you guys how powerful this volume-weighted moving average is, especially during those high volume, high volatility market environments that we're going through right now. Alright, the third indicator that you must have during the bear market is no other than my favorite DeMark 9 indicator. It's not only my favorite, but also is considered the single most important indicator by a lot of heavyweight hedge fund managers like Steve Cohen, Paul Tudor Jones, Tom Lee, Raoul Pal, and many more. In fact, this indicator is so powerful that the inventor of this indicator, Tom DeMark, was exclusively hired by Steve Cohen as his chief advisor for his very well-known hedge fund Point72 for over 20 years. I've made 2 separate videos on how this DeMark 9 indicator works and how we can use it to find high quality trade ideas, so I will not waste too much time on that in this video. Do check out these 2 videos if you want to learn more about this hedge fund's favorite indicator. I will leave both of the links in the comment section below. Alright, before we go, I want to show you guys how to get all these 3 indicators on TradingView for free and also some of the important settings for them. First, the volume profile indicator. After you open your TradingView, go to the indicators on the top. Then search for volume profile. You will see a whole bunch of different types of volume profile indicators. What we want is this visible range profile indicator. Click on that and you will see it on your chart. But before we use it, we need to make sure the settings are right. So we click this arrow under the stock ticker, find the indicator, and go to settings. In the settings, we go to inputs. Then we need to change this row size to 50 so that we can have more bars and each bar can be more accurate to tell us the price levels. Then we need to change the value area volume from the default levels to 80 so that we can track where those 80% of the total volumes has been traded. Alright, once we've done that, click OK, then we're good to go. Also, if you want to add a fixed range profile indicator, here's how you can do it. Go to indicators, search volume profile, click on fixed range volume profile, close this page. Then on the chart, you can connect any 2 points you want, and the fixed range volume profile indicator will appear on your chart at the exact time period that you connect. If we zoom in or zoom out on the chart, we can see that the values of the visible range keep changing because they need to readjust the new time period whenever we zoom in or zoom out. But the fixed range values always stay the same. Alright, for the volume weighted moving average is very straightforward. All we need to do is just to search the name in the indicators and click on that. The default setting is 20 days, but we can change it to any time period we want. Just remember, this length value is the one that you need to adjust if you want to change the time period. For the DeMark 9 indicator, it's a little different. First, you need to download the latest source codes for TradingView version 5 in order to run this indicator. This is the page to download the source code. I will leave the link of this important page in the description below as well. Once you use the link and complete the download, you will receive this PDF file. Then all you have to do is to copy the entire code from this line all the way to the end and paste them to the Pine editor on your TradingView. But here's an important thing I want to highlight here is that if you directly copy and paste from the PDF file without any changes, you might have some errors on your TradingView. This is because the PDF file has some restrictions on the direct copy function. But no worries, all we need to do is just to readjust those alignments of the code on your TradingView, and here's how you can do it. And also, if you notice that our 2 emoji icons are missing here, it's a super easy fix. We can just go to getemoji.com, find our emoji icons, copy and paste them into our Pine script editor. Once we've done that, click this Add to Chart right here, and boom, you will see the DeMark 9 indicator right on your chart. It works on the majority of the markets and all different time frames. Cool, there you go. These are my top 3 indicators that I strongly believe will help your trading tremendously, especially in such a depressing bear market that we're going through right now. Do let me know in the comment section below if you want any more deep dive videos on any of these indicators. Alright, that will be the end of this video. Hope you guys learned something valuable. If you are new to the channel, my name is Vic. Thanks so much for watching, guys, and I'll talk to you guys soon. Bye for now.